Okay, chapter 15 is still finance, but luckily for you, not math finance. You might not be so thankful for it once we get into it. So, chapter 14 is all about how loans are structured, individual loans. Remember we started talking about how the different foreclosure processes work, whether it's a lien theory state or whether it's a title theory state. And then we talked about the, calculating balances after you had made a certain payment. And we talked about calculating interest over the life of a loan. All of that has to do with a singular loan, one loan by itself. Does that make sense for everybody? Chapter 15 is about the much bigger lending marketplace. It's about loans being made by the thousands, loans being made by the millions. It's not about singular individual loans, it's about bunches of them and how big categories of loans work. Does that make sense for everybody? So we've kind of moved away from what's the interest on this individual loan. Now we're going to talk about the factors that impact lots of mortgages being made across the country all at the same time. That's what chapter 15 is about. Now, the primary mortgage market is what we have discussed so far. The primary mortgage market is where loans are made. So the primary mortgage market, you're dealing with, I like to remember it this way, primary, one. You're dealing with one loan at a time. That's where the borrower sits down with the lender and decides if they can get a loan. That's the primary mortgage market. Is everybody okay with that definition? Okay. Now, usually those loans are made by banks in the primary market. That's the most common source of loans being made. They don't have to be, but that's the most common source of loans being made in the primary market. The fees that are made in the primary market are interest over the life of the loan, and then whatever fees can be collected up front at closing. Like, give me an example of a fee we just learned how to calculate that would be collected up front. Discount points. Discount points is an example of how primary mortgage lenders make their money. Also something called origination fees. What do you think an origination fee is? It's basically an application fee. Origination is the beginning, right? So they're charging a fee to write the loan. That's another way that primary mortgage lenders make money. And of course, then there's the interest earned over the lifetime of the loan. So those are all ways they make money. Primary mortgages are made by two groups of people, either mortgage bankers or mortgage brokers. The best way I can think to describe this difference to you is to think about what a real estate broker does. Real estate brokers, do we sell only our stuff or do we sell everybody's stuff? That's exactly what a mortgage broker does. A mortgage banker works for a bank. Whose money do you think they are trying to lend? That bank's money. Only that bank's money. If you go into you can't go into a Wachovia branch. If you go into a Wells Fargo branch, if you go into a Bank of America branch, do they have somebody sitting in there who will talk to you about a mortgage loan? Yes, that person is a mortgage banker. Because they are employed by the bank, they are there to sell loans on behalf of that bank. Does that make sense to everybody? There are also mortgage brokers who don't work for any one particular lender. And just like real estate brokers can go out and find the best deal possible amongst everything that's available on the market for our buyer clients, mortgage brokers can look at everything that's available on the lending market and find the best deal possible for a borrower. So they can lend Bank of America's money, they can lend Wells Fargo's money, BB&T's money, SunTrust money, it doesn't matter. It's an unlimited number of places where they might be getting the money from. The truth is they're not really lending money at all. What they're doing is connecting the borrower with a lender. Does that make sense to everybody? And then they're paid a fee for that. They're usually paid an origination fee. So the borrower would pay an origination fee. They also are probably paid a fee by the bank itself. Because if you think of it, if the bank didn't have to do any work, are they willing to pay a fee for you writing a loan for them? If you're selling a loan for Bank of America and you're doing all the work for them, yes, they're probably willing to pay you a fee. So these mortgage brokers might get compensated both from the lender and from the borrower for making the connection between the two of them. Does that make sense to everybody? The big difference between them is these folks on the top are usually salaried, and these folks down here on the bottom are commissioned. Brokers are commissioned. Okay? Now, all of that's the primary mortgage market. That is very different than the secondary mortgage market. The secondary mortgage market is the second place a loan ends up. So we've made the loan. Great. We've loaned out the money. The borrower's got the money. They've bought the house with the loan. They're making their mortgage payment. What money is the bank going to make off of that loan from now forward? Interest. And only interest. There's no other money to be made off of that loan from the bank's perspective from that point forward. Does that make sense to everybody? They may have charged discount points. They may have charged origination fees. They may have made a bunch of money at closing. But now it's a long, slow burn for the next, usually how many years? 30 years. Banks don't like that. They don't want a long, slow burn. Have you ever met a banker? They don't want to be patient and make a little bit of money for a long time. What do they want to do? Make a lot of money today. So what they would rather do, rather than hold that loan and make interest off of it for the next 30 years, is find somebody they can sell that loan to. Remember yesterday we talked about the fact that promissory notes are negotiable, which means they can be sold. Once these loans are made, the banks most often do not keep them. They sell them. They sell them to investors. And the reason the investors are willing to buy them is because the investors do want that long, slow, safe return on their investment. Think of you, how many of you have a retirement fund, like a 401k, a Roth IRA, something like that, okay? That money, do you want it invested in something that's relatively safe? Are you planning to touch it anytime soon? So, slow works for you, right? And safe works for you. Well, folks, it don't get any slower or safer than mortgages. A 30-year fixed rate mortgage. So where do you think the biggest source of funding for selling these mortgages comes from? Who's buying all these mortgages? Not banks. Banks are selling them. Who's buying them? You are, you are, and you are. Because every dollar you got tied up in your 401k, the person who's managing that plan, guess where they've likely dumped every dollar of that money? Into something called mortgage-backed securities. In other words, they're buying mortgages with it. Because traditionally, that has been shown to be the safest place to invest money long term, because people do everything they can to avoid losing what? Their house. They'll make that payment when they don't make any other one. Are you following me on that? That is the secondary mortgage market. Now, the main purpose from an overall standpoint, yes, it makes money for the investors, and yes, it makes money for the banks. Those are byproducts. Here's the main purpose of the secondary mortgage market. We don't want the banks to run out of money. Because if the banks run out of money, they can't do what? Lend money. Imagine if you went to the bank one day and said, well, I want to qualify for a mortgage. And said, well, you got to come back next week because we're out of money this week. Would that have a negative impact on the housing market, for example? I mean, think of it would be like one of those old-fashioned motels beside the road with a vacancy, no vacancy sign. It said they would have one, it'd be like the Krispy Kreme hot and now sign, out in front of the thing. You could only go in the bank when the light was on, money or no money, right? And we don't want to have that kind of a system. So the best way to ensure that the banks don't run out of money is to give them a way to cash out on the money they've already loaned out, to get that money back in. So that's what they do. They make these loans. They go do the work. They find the borrower. They do the advertising. They get you to take out the loan. And the minute they lend you the money, they start looking for somebody to do what? to buy it from them. They want to sell that loan. And not only are they going to sell it, are they going to upcharge it? Are they going to mark it up like any other thing that you buy and sell? Absolutely. So if you've borrowed $200,000 from Bank of America, when they sell that note to the investor, are they going to sell it for $200,000? Or are they going to sell it for $201 or $202? And now they've made a couple $1,000s, and more importantly, they've got what? They got their money back to do what? Lend it out again. To lend it out again. That is the purpose of the secondary mortgage market. It keeps the machine cycling, right? It keeps the gears greased, the thing moving. Does that make sense for everybody?
So
yeah, of course.
When the market fell, was it what happened?
So what happened? So what happened when in the 2000s when the market collapsed? I'm assuming you're talking about the 2000s, right? You're not talking about like Great Depression.
No.
Okay. So we're going to talk about the Great Depression in a minute. So what happened? Well, what happened was greed. That is the best way to describe what happened. Banks make significant money by writing a loan, because they charge an origination fee, they charge an application fee, and then they immediately turn around and do what with the loan as soon as they make it? They sell it, and they upcharge it when they sell it. So, a bank like Bank of America, if they make a $200,000 mortgage loan, they might make $5,000 or $6,000 in that day that they issue the loan, because they sell it the same day, by the way. It's sold the same day. So they might make so think of it. They literally only have to have the $200,000 for, what, 5 hours? Just long enough to fund the loan. And as soon as it gets funded, immediately they turn around and sell it. And not only do they get their $200,000 back, but they get these fees, and they get the markup, and they've made $5,000, and they start looking for somebody else to do what? To lend it to again. Does that make sense? Is that like crack cocaine if you're a banker? Yes. When you start realizing you can make $5,000 at a clip. Now, and that's only on one $200,000 loan. How many $200,000 loans in a day is Bank of America making? Thousands. Tens of thousands. And it is like crack. It's like, gimme. And so the banks were clawing over each other to make more of these loans because they could sell them as fast as they could make them. Does that make sense? There was tons of cash in the secondary mortgage market. People were dumping money into the secondary mortgage market because mortgages were performing so well. They were outperforming everything they'd ever done. All of a sudden, returns on mortgages were better than they had ever been. And nobody stopped to question why the returns on the mortgages were better than they had always been. The reason they were better than they had always been is because the banks, in an effort to make more loans, were increasingly lending to riskier borrowers. They were making more and more risky loans. If you figure out, because here's the thing, if you're the bank, do you really care if that person pays the loan back? No, because what are you doing with the loan as soon as you lend the money out? You're selling the loan off to somebody else. The risk goes away. You've got your money back. So you don't really give a shit if they pay it back. All you care about if you're the bank is that you can do what with that loan? That you can sell it. And so what started to happen is that investors in the secondary mortgage market really kind of stopped paying attention to what they were buying. The banks were making increasingly risky loans, and so you would think, therefore, investors would go, I don't know if I want to buy that loan from you. That should have been the natural pullback. Does that make sense? That people would have said, yeah, I don't trust that borrower. I don't want to buy that loan. And if the bank couldn't have sold that loan, they wouldn't do what with any more of them? They wouldn't make more of those loans. But as long as they could sell that loan, and that worked out just fine, did they go one step further and get a little bit riskier? And they just kept pushing that envelope further and further out. I read an article, and it's been several years ago now. If you go back to 2000, the average credit score of a 30-year home loan borrower in 2000 was 670. That was the average credit score, was 670 across the whole country. By 2005, that average score had fallen to a 625. That's the average. Now, when I got into business, 620 was like the lowest you could possibly have, and all of a sudden the average credit score had fallen down to where it had been for the lowest possible when I started. And what that meant was we were putting a lot of people into the system who had reasonably never shown that they could be responsible with money. Does that make sense for everybody? And so they started making loans to a lot of people who, simply put, didn't really understand what they were getting into. And then they got into much more exotic types of loans. They got away from doing 30-year fixed rate loans, and they started doing ARMs, adjustable rate mortgages. And they started doing things even more exotic than that, option ARMs. So, you know, Wachovia used to be a thing, right? Yeah. I mentioned their name earlier. It used to be kind of a big deal. 4th largest bank in the country. So Wachovia is an interesting story. Wachovia bought a company called World Savings. World Savings was based in California. World Savings had a very interesting loan product. It's called an option ARM. That's the technical name for it, option ARM. Well, we know what the ARM part means. What does that mean? Adjustable rate mortgage. Here's what the option part meant. So this is not what the statement said when the borrower got it. When the borrower got their statement, it had this across the top of it. This was their trademark name for this loan. It was the pick-a-payment loan. Rather than you just having a mortgage payment every month, you had your choice. You had your option of what payment to make. And there were 3 choices on there for you to choose. And so here's what they said. And let's say that's $1,700 minimum due. And then the second box would say term, $1,975. And then the third box would say fully amortized. Because everybody knows what that word means, right? Everybody in society knows what that word means. Y'all do now, but you didn't before yesterday, right? 2125. So those were the 3 options that would show up. 1,700, 1,900, 2125. What box do you think people checked? Now, let's go back to the definition you just learned in the last chapter. What does term mean? What kind of loan is that? Interest only. Here's what that means. If you had paid $1,975 a month, you were only covering what? The interest. Look at the minimum payment. What is it? It's less than the interest that was actually building up. These people thought they were making a house payment and paying their mortgage down, and they actually owed more and more money every single month. And then, that does not even begin to talk about this gremlin right here. So in a year, when that interest rate jumps by 2%, and the minimum number goes from $1,700 to $2,900 a month, and these numbers jump up to like $3,500, what happens to that borrower? They get foreclosed because they can't make the payment. They can't make the payment. But they actually didn't get foreclosed on for a while, because that was the genius of how devious this system was. Because for a while, the banks would contact them. They knew they were in trouble, because they could see they were making this minimum payment every month. So right before their loans would reset, the bank would contact them and they'd go, listen now, your loan's about to reset, and your payment's going to go up like $800, $900 a month. We don't want to see that happen to you. And they would say, oh God, no, I can't afford that payment. And the bank would say, we got a solution. We can what? We can refinance you. We can refinance you. And heck, here's the thing. Your house has gone up so much in value since you bought it. Not only can we refinance you and make sure that you get locked in with this low payment for another, we'll let you take some cash out too. And so they'd refinance and they'd pull cash out. Now they're deeper in the hole, right? Here's the problem. Do you eventually run out of borrowers? I don't care how low you go on the standards, do you eventually run out of people, period, to qualify for a loan? The increases in value, folks, were because they kept adding people to the buying group. When they ran out of people to run to the buying group, what happened to property values? They stopped doing what? They stopped going up. And when the property values stopped going up, this person couldn't refinance anymore. And when they couldn't refinance anymore and that rate actually reset to that higher amount, what happened? They got foreclosed. And when they got foreclosed, what did that do to the other property values in their neighborhood? It knocked them down even further. And so some people who were maybe scraping by before, all of a sudden are like, holy crap. And then they go into foreclosure. And it's just, and then it's just unwinds like a big, ugly spring. Once it's set loose, once that tension gets released, it just, you know, that's where, I mean, that's what happens. And that's, so, I mean, hopefully that gives you some insight as to, you know, what happened. It was fake demand. There never was that demand for the housing market. And so that's why you always have to be suspicious when you see prices running up so quickly. Does that sound familiar, by the way, around here right now?
Yeah, they're qualifying.
You know? And are they dropping qualification standards right now? For those of us who've seen it before, it's very scary to watch it happen right now. And people ask me this question all the time. Are we doing the same thing? And I'm like, yeah, I kind of think we are. I kind of think we are, unfortunately. Okay? Does that help? Does that help you a little bit with the understanding? So, the secondary mortgage market is where these loans are going to get sold. Now, you need to know these three entities that exist in the secondary mortgage market. One is much more important than the others, though. The one at the top, Fannie Mae, is the one that ultimately is you're going to see most of the test questions about, and where most of you need to have your knowledge. So I have to kind of go back to the Great Depression now. I know you didn't ask about it, but I kind of have to go back to it. The Great Depression became the Great Depression because of the mortgage market. It didn't start in the mortgage market. It started in the stock market. It actually started with a stock market collapse. The problem became that banks at that point in time never sold their mortgages. They loaned out money that had been deposited with them. You know, if you borrowed money from the bank, you were borrowing money that had been put on deposit at that bank. Does that make sense for everybody? So, when the stock market collapsed in 1929, people got scared. And if you have your money in the bank, you get scared, what do you go do?
Yeah.
You go get it. And so there were runs on the banks. The banks didn't have enough money to give people their money back, because what had the banks done with this money? They had loaned it out. So people were literally standing outside of, I mean, they were shooting bankers in the street. They were rioting outside of, I mean, think about what would happen if you couldn't go to the bank and get your money. And so the banks, the only response the banks knew how to do was to call all their loans due. The banks were like, if we've loaned all this money out, we don't have it anymore, and all these people are going to kill us if we don't give it back, then you got to give us the money back. Well, can people just stop their lives and all of a sudden write a check and give you the money back? Some can, but very few. And so what you ended up with was millions of foreclosures that happened all at the same time because the banks called these notes due. Well, what does that do to the value of housing when you have millions of foreclosures all at the same time? Everything goes to shit, right? Very quickly, too. And then there was this other problem, that there was no way to get money back into the system. Because up to that point, what money did banks lend out? Other people's money that was been put on deposit, right? What kind of trust did people have in banks at this point in time? None. So how much were they depositing with the banks? Nothing. And so the banks didn't have any money to lend. So even people who wanted to move forward, to get back going, and like, you couldn't borrow money. And so essentially the credit markets froze for a decade. And that's why the Great Depression lasted so long, because there was no movement of money. So fast forward, as part of the recovery from the Great Depression, Congress debated this need to essentially have a constant flow of money into the mortgage industry. That banks needed a way to be able to get more money to lend. So Congress created Fannie Mae. And Fannie Mae is not really its name. It's the Federal National Mortgage Association, which you don't need to know. Just FNMA, over the years, people have kind of colloquially named it Fannie Mae based on the initials, FNMA, Fannie Mae. You can tell it's old, you know, right? So Fannie Mae was created by Congress. Here's the interesting thing. Fannie Mae is actually a private company, but it was created by the government. And its sole purpose was to buy mortgages from the banks. Because the idea was if the banks had a place that they could come to and sell their mortgages, then the banks would have more money to do what? To lend out. Does that make sense for everybody? But Congress recognized the major issue here was that nobody was going to invest in Fannie Mae because mortgages were a dead end at that point in time. So they needed to jumpstart the system. So Congress did one thing that's never been done again for any other company that I'm aware of. They jump-started it. And it's been used several times since, too. Congress gave Fannie Mae the ability to borrow money directly from the United States Treasury. It's the only private company in the world that can borrow an unlimited sum of money, there's no cap on it, directly from the United States Treasury. The idea was if Fannie Mae could get started using government money and buy a bunch of mortgages, and the mortgages were profitable, then private investors would see that as something they would also want to invest in. And as the private money came in, the government money could be what? Taken out. Does that make sense for everybody? And that's exactly what happened. And for decades and decades and decades, Fannie Mae chugged along on private money until 2008. In 2008, when the housing market collapsed, again, everybody ran for the exits. And nobody was investing in mortgages. People stopped investing in Fannie Mae. Here's the thing, though. Fannie Mae never stopped buying them. You know whose money Fannie Mae used to buy them? The United States federal government's money. The U.S. Treasury's money. To the tune of $1.4 trillion. $1.4 trillion that Fannie Mae borrowed from the United States federal government in 2008 to 2011. Here's the interesting thing, and this is the part of it that rarely ever gets discussed. You know how much of that money's been repaid? Every penny. Every single penny plus interest. So when people hear, and when Fannie Mae gets a bad name, people ought to go, are you crazy? It made money for the federal government. Not only did it make money, guess what it prevented? Another depression. Because at no point during that collapse did we ever have a time where you couldn't go get a mortgage because the banks couldn't get money. Because Fannie Mae was still there buying those mortgages even when nobody was investing their money in it. Does that make sense?
Kept the hot light on.
It did. It kept the hot light on. It kept the thing moving. It kept it moving. I mean, so it was definitely put to a test. I mean, we should honestly go back and really compliment those people in the 40s because they knew more than what they were doing than we give them credit for. To create a system. Does that make sense for you guys? So Fannie Mae's job is to do what? Buy loans. They are the secondary mortgage market for the most part. Now these other ones are much smaller entities that also buy loans in the secondary mortgage market. But Fannie Mae is by far the biggest one. Everybody okay with that? We're good with the differences there? Generally speaking, Fannie Mae buys very strong mortgages, the ones that you would expect the borrowers to repay. These are going to be well-qualified borrowers, because Fannie Mae, again, is a private company. Nobody's going to invest their money in a company that's buying a bunch of junk mortgages. So the idea is that Fannie Mae buys really high-quality mortgages. Ginnie Mae, on the other hand, purchases much more risky loans. Ginnie Mae has never been intended to be a money maker. In fact, Ginnie Mae is too risky for the private market. Ginnie Mae is the federal government. Ginnie Mae stands for Government National Mortgage Association. Ginnie Mae buys those loans that Fannie Mae looks at and goes, mm-mm, mm-mm. And here's the thing. You'd be shocked at which ones Fannie Mae looks at and goes, mm-mm. How many of you ever heard of an FHA loan? Fannie Mae looks at that and goes, no way. How many of you ever heard of a VA loan? Fannie Mae looks at that and goes, hell no. Here's the thing. This is why. Those people have no skin in the game. A VA loan is a 100% loan-to-value loan. Is that a risky mortgage if you're the lender? If you've loaned out 100% of the value of the property, are you taking a huge risk that that money is not going to get repaid? Absolutely. And so it's not that Fannie Mae is going, we don't want to help veterans. Fannie Mae doesn't care that they're veterans or not veterans. What Fannie Mae cares about is the risk associated with the loan. And because it's a very high loan-to-value ratio loan, Fannie Mae's like, no, we won't buy that. Well, Congress came back several years after Fannie Mae was created and said, we need something that helps grease the skids for these government-backed loans, like VA loans. Because they created the VA loan program and nobody could get one. And the reason they couldn't get one is because the banks wouldn't make them. And why wouldn't the banks make them? They couldn't do what with them? They couldn't sell them. Because the one place that the banks had become addicted to selling to, which was Fannie Mae, said what? Nope, we won't buy that. We only buy loans where people got skin in the game. In fact, Fannie Mae wanted to buy stuff where people put at least 20% down. That's why that's still the magic number. Because Fannie Mae said that if you put 20% down, it was almost impossible for them to lose on that loan. If you think about it, that's true, right? Number one, if somebody puts 20% down, it's very unlikely they're going to be foreclosed on in the first place. Does that make sense? Number two, even if you had to foreclose on them, there's a very high likelihood that you're going to be able to sell it for at least as much as you've loaned out, get your money back, and be okay. Because you've only loaned 80% of the value of the collateral. Is everybody with me on that? So Fannie Mae's kind of number was 80% loan to value. Well, you look at that VA loan and at 100%, they were like, no, we're not buying that. So Congress created something called Ginnie Mae, the Government National Mortgage Association. And Ginnie Mae's job was to buy the junk, buy the garbage, buy the stuff that Fannie Mae would not buy, but the government thought should be made anyhow, should be loaned in, like VA loans and FHA loans. Here's the interesting thing. Guess what Ginnie Mae does? Doesn't hold them. Sells them. Guess who it sells them to? Fannie. Ginnie Mae sells them to Fannie. Well, I thought Fannie didn't want the things. They don't, unless you guarantee them. And that's why we call them government-backed loans. Because what happens is Ginnie Mae buys that VA loan from Bank of America. And remember, Ginnie Mae is the federal government, right? Can you, when you sell something to somebody, put a guarantee on it? Can you say, I guarantee you won't have any problems, and if you do, I'll pay for it? Sure you can. You can put a warranty on anything, can't you? That's exactly what they do. The federal government buys it, puts a warranty on it, a guarantee, says if there's a default, who will pay?
Ginnie. And
Ginnie is who? The government. So if there's a default, we'll pay. Is Fannie now interested in buying that mortgage? You can't lose on it now. And so that's how it works. That's how VA loans and FHA loans end up at Fannie Mae anyway. Because they get first sold to Ginnie Mae stamps the government's guarantee on them, and then Fannie Mae's very interested in them and buys them. That makes sense for everybody? Okay? That's really all you need to know about those behemoths. If you understand that much, you understand definitely enough to be able to answer any test questions about it. Okay? The idea of a subprime mortgage, those are the mortgages we were talking about to people that probably should not have been qualified. Generally speaking, well-qualified borrowers are called prime borrowers, and so anybody lower than that is called a subprime borrower. For the most part, if Fannie Mae will buy the loan, you're considered a prime borrower. If Fannie Mae won't buy the loan, you're considered a subprime borrower. Mostly, subprime loans were pretty rare prior to the early 2000s, and they became pretty common. Yes, ma'am.
When do you find out if you're subprime or?
When you apply for the loan. When you apply for the loan and you see what kind of loan they qualify you for. If they qualify you for any of the main mortgage types, a conventional mortgage, an FHA mortgage, a VA mortgage, you're a prime borrower. Because ultimately, even if it has to go through Fannie Mae will ultimately buy all of those loans. Whereas a subprime loan, Fannie Mae won't touch it in any way, no how, no whatever. And so what that means is that the bank either can't sell that mortgage or they have to sell it to other investors, and that means the interest rates are going to be much higher on it because those other investors are taking a big risk, and so they want a bigger interest rate. Okay, everybody okay with that? All right. So different types of loans. You need to know this for sure. A conventional loan. A conventional loan is simply one that is not backed up by the federal government. That's all conventional means. That's the only definition. I cannot stress enough that you need to know this definition. I cannot stress enough how much people get wrapped around 60 different ways. I'll ask them about conventional loans, and 30 minutes later they're still yapping and they've not said anything about government backing. And I literally want to die right in front of them. Because the first thing you should say about a conventional loan is what? It's not government backed. It's not government backed. Now think about that. If it's not government backed and Fannie Mae will buy it anyway, the borrower must be pretty dang what? Not only serious, but
Rich?
Rich is the one way to put it. Well qualified, not risky. The borrower must be a pretty good one. So give me an example of what makes somebody well qualified. 20% down makes them real well qualified, right? A high down payment. That's the best, that's music to any lender's ears. Because if you've got a high down payment, you're automatically lower risk. Does that make sense? What other things makes borrowers highly qualified? Good credit, good income, steady job, you've worked at it a long time. Those are going to be your conventional borrowers. Conventional borrowers are going to be your better qualified borrowers because they're able to get a loan without anybody requiring that that loan be backed up by who? By the government. Fannie Mae will buy that loan without the government's backing. So these are your most well qualified borrowers. They're borrowing less money, they make more money, they have better credit. That's it. They got a down payment. That's exactly right. Lots of it. Usually at least 20%. That's not necessarily true, but that's sort of the magic number. Everybody okay with that? Most of the time, that is at least 20% down. Now, it could be less than 20% down, and they still be conventional. Because what's the definition of conventional?
Not bad.
Not backed by the government. Not backed by the government doesn't mean not backed. Could you be backed by something other than the government? You could have mortgage insurance. Mortgage insurance is insurance against bad stuff happening with your mortgage. What bad stuff could happen with your mortgage? You don't pay. That's about the only one the lender cares about. That's the only one they care about with a mortgage is that you don't pay. So what do you think mortgage insurance is? Insurance in the event you don't what? You don't pay. And who does it protect? Does it protect the borrower or does it protect the lender? It protects the lender. So here's what you need to know about mortgage insurance. It's not always necessary. if the borrower has enough skin in the game, folks, if they have enough of a down payment, then Fannie Mae is not going to require them to have mortgage insurance because Fannie Mae feels safe. What did we say that number was? 20% down. If they put 20% down, Fannie Mae is fine with it. They don't need mortgage insurance. But you start looking at that gauge, and so like this borrower over here, this is a low loan-to-value loan. There's no risk associated with this. Would Fannie Mae buy this loan? They wouldn't?
Yeah.
With low risk.
Low risk, of course. They'd be happy to buy this loan because they've only borrowed like 30, 40% of the value of the property. So what if they don't make a payment? What can we do? Foreclose, sell it, and we'll get our money back. Absolutely, there's very little risk here. So Fannie's happy to buy that. Medium risk, 80% loan to value. Fannie Mae will still buy that loan with no mortgage insurance. High risk, When you get over here and you get above 80% loan to value, Fannie Mae's like, no, we don't trust you anymore.
100%.
You know, maybe you borrowed 100%, maybe you borrowed 95%, maybe you borrowed 90%. Anything above 80, they don't trust you anymore. And so they're going to force the borrower to purchase what? Mortgage insurance. And what do you think that mortgage insurance is going to do? Protect who? The lender in the event the borrower does what? Defaults on the loan. Now here's what you need to understand about mortgage insurance, and that's why I leave this slide up. If you're right here, you don't need it, right? Does everybody agree with me? If you're here, you need it. Mortgage insurance does not cover the whole loan. It only covers the top portion of the loan because this portion always remains uninsured. Does that make sense? This portion doesn't need to be insured. It's this top portion that the lender is concerned about. This is what the mortgage insurance policy covers up here. So let me give you an example of what I mean. Just with numbers real quickly. Let's say we got a $100,000 loan, and it's a 100% loan-to-value loan. Is that a risky loan? Yes, very. So we got a $100,000 loan, 100% loan-to-value with a high-risk loan. Is this borrower going to have mortgage insurance? What do you think? Yes. Yep. $100,000 loan, 100% LTV? Yes, absolutely. Tell me something. What loan to value would they not have needed mortgage insurance? 80%, right? What's 80% of $100,000? 80,000, right? This amount is uninsured. The first $80,000 is uninsured because if you'd only borrowed 80, they wouldn't have required you to do what? To have insurance in the first place. You're only buying insurance on what? That top $20,000 piece. So is it possible the lender could still take a loss even if there's mortgage insurance on the property? Yeah, if it really goes badly. If they foreclose on the thing and it sells for $70,000, is there still going to be a loss involved? Yeah, because the mortgage insurance is only going to cover how much? 20. Does that make sense? Now, there's no math here, but I want you to understand the concept of it. Because here's what's going to happen on the test. I'm going to warn you about it right now. They're going to use phrases like fully insured against loss. There's no such thing as a loan that's fully insured against loss. Just the top portion is insured. Are you with me on that? There's a big difference there. So there's still some risk here. But it's the same risk they were willing to take no matter what. You only have to buy insurance when you go above those limits. Everybody okay? All right? So, When borrowers wish to borrow more than 80% of the value of the home, lenders usually require them to have insurance on the debt above 80%. So not insurance on the whole debt, but just on the amount above. So, for example, if they get a 90% loan-to-value loan, what percentage of the value of the property is going to be covered by the mortgage insurance? That 10% gap. Does that make sense? If they get a 95% loan-to-value loan, what percentage of the value of the property is going to be insured? Not 5, 15. Up to 80 is uninsured. They got 95%, so we got to insure from here to here. So 80 to 95 is 15, right? It's not from 100 down, it's from 80 up that has to be insured. Are we all good with that? That's the idea. Now, if you have a conventional loan, the mortgage insurance you could get is called private mortgage insurance. Well, remember, what is the definition of conventional? Not government-backed. Notice I didn't say not backed. Could you have insurance on a conventional loan? Yes. When would you need insurance on a conventional loan? When you borrow what? Not less. More than 80% loan to value. So could I get a 90% loan to value conventional loan? Yes, but I'm probably going to have to buy what? Private mortgage insurance. We call it private mortgage insurance when it's on conventional loans. Because guess what kind of mortgage insurance you get on government-backed loans? What's the opposite of private? Government. You get government mortgage insurance. Private mortgage insurance versus government mortgage insurance. If conventional loans are not government-backed, are they going to have government mortgage insurance or are they going to have private mortgage insurance? Private mortgage insurance. Private mortgage insurance on conventional loans if necessary. Okay? This brings us to the first of the government-backed loans, the FHA loan. FHA stands for Federal Housing Administration. I don't think you see that on the test. But here's what you do need to know. And this is silly stuff that you will miss on the exam because your eyes glaze over and it's boring and I get that. But I'm telling you, you've got to pay attention to it. FHA doesn't make loans. The government, no government agency makes loans. They might buy them, but they don't make them. And if they don't make loans, they also don't set interest rates. Who makes these loans? Banks do. So who sets the interest rates? Banks do. Period. And end of story. The banks make the loans. The banks set the interest rates. The banks decide if you get the loan. FHA does not make loans. What FHA is a mortgage insurance program. FHA doesn't even buy loans. Who's going to ultimately buy these loans? Fannie Mae. They're going to eventually end up with Fannie Mae. But only once what kind of guarantee gets put on them? A government guarantee. That's the government mortgage insurance that we were just talking about. So on a government-backed loan, you don't have private mortgage insurance. You have what? Government mortgage insurance. And folks, it's not free. As a matter of fact, it's more expensive than private mortgage insurance. Government mortgage insurance is very expensive. Here's what you need to know about government-backed loans. No borrower should ever consider a government-backed loan unless they have first attempted to get a conventional loan. You have tons of borrowers who the first thing they do is run out and think, I'm going to get an FHA loan. No. FHA loan is the most expensive type of loan you can obtain because it was designed for the riskiest borrowers in the market. Do you think as a risky borrower you're going to pay more for everything? Yes, absolutely you are. And it's not going to be interest rates. That's another big misconception. People think FHA loans have higher interest rates. Actually, they don't. They have lower interest rates a lot of times. Or similar. It's not the interest rates that are expensive, folks. It's the fees. The fees associated with these loans are incredible. Fees at closing. For example, on an FHA loan, currently, the origination fee is 1.5% of the loan amount. So if you're borrowing $200,000, that's a $3,000 origination fee at closing. Additionally, that government mortgage insurance is an additional 1.5% of the loan amount annually. So that on that same loan, that would be $3,000 annually for the mortgage insurance. Folks, that's $265 a month for the mortgage insurance. Does that sound like the kind of loan you want to be in? So now let me tell you why you would get an FHA loan. Right there. High what? Loan to value. In other words, the borrower doesn't have what? They don't have a down payment. They better have some down payment because FHA requires some down payment, but it's a small one, 3.5%, which means an FHA loan is what loan to value? 96.5. Up to 96.5 loan to value on an FHA loan. Does that make sense for everybody? Does that mean, do you understand why it's risky now? Okay? Always check conventional loans first, because if they can get a conventional loan, that's always going to be more affordable for them. Even conventional private mortgage insurance is cheaper than government mortgage insurance. This is a big moneymaker for the federal government, by the way. The FHA loan program, the mortgage insurance premiums, huge moneymaker for the federal government. They are 30-year fixed rate loans. You should know that about FHA. They're always 30 years. They're always fixed rates. FHA, again, does not make the loans. They just provide what? The insurance. That's all they do. Look at that bottom one down there. It says owner occupancy required. What do you think that means? That the person who is buying the property has to do what? They have to live there. One of the biggest sources of loan fraud in this country is somebody taking out an FHA loan and then turning around and renting out that property. That is a felony. You go to prison for that. Okay? Do not participate in that if you know what's going on as a real estate broker. FHA loans require the owner to live in the property. Everybody okay with that? All right? As far as some other things you need to know about FHA loans, it's got to be approved by an FHA appraiser, or appraised by an FHA approved appraiser rather. So you can't just use any appraiser, they have to be FHA approved. There are no prepayment penalties on them, and they are fully assumable loans. What does that mean? When we say the loan is fully assumable, what does that mean?
Somebody can assume.
Somebody can assume, but what is that? What's an assumption with a loan? Come on. What's an assumption? Changing the parties when? What's happening? Give me the whole story. Don't give me these little snippets because I don't know if you know what you're talking about. My suspicion is no. Tell me from beginning to end. What's happening for an assumption to happen?
The property's sold.
There we go. Finally, somebody started at the right place. The property's being sold, and then what's happening?
They can take that loan that you already had in place.
The buyer takes over the existing mortgage rather than getting their own. That is an assumption, right? All government-backed loans are fully assumable. Now I'm going to tie it together with something that's much tougher from yesterday. Since you struggled with the easy one, I hate to ask this one. Remember when we talked about those different clauses that could appear in a promissory note? We talked about the acceleration clause, the alienation clause, prepayment penalty clause. Y'all remember those? We said one of those prevents assumption. Which one of those prevents assumption? The alienation clause prevents assumption, because the alienation clause says if you sell it, you have to do what? You've got to pay it off. Well, obviously, if you're paying it off, it's not being assumed. Does that make sense for everybody? So would an FHA loan have an alienation clause in it? No, because if it did, it wouldn't be what? Assumable, and it is assumable. That's tying it all together. That's the kind of question you could expect in the finance section of the test. Would an FHA loan have an alienation clause? And the answer is going to be no, because that would prevent what? Assumption. Luckily for you, you do not need to learn all of the different types of FHA mortgages and all the different numbers that go with them. you do need to know these two, though. I've given you two on the next two slides, and you need to be familiar with them, because those two could show up on a test. The 203B is the most common one. That's the single-family home FHA loan. 203B. Make yourself a flashcard. That's the common single-family FHA loan. 30-year fixed rate. Here's what it can't be used for. Condos. Condos are not single-family homes. Condos are inherently more risky than single-family homes. Could you use a 203B for a townhouse?
Yes.
Yes. Could you use it for a detached home?
What?
A detached home. Unattached. Detached. Single-family. They all mean the same thing. Yes. But could you use it for a condo? No. For a condo, you need a 234C. Just remember the C part. C stands for what? Condominium. That's the FHA condominium loan. Okay? It has its own loan type. It's a different application. It's a different qualification. So the 203B is the standard one for pretty much any other property. The 234C is for what? For condos. Make sure you know those two types. And that's it for FHA mortgages. Yes, sir.
Just going back to the general characteristics,
Yeah.
kind of just gave a lot of information in that.
Mm-hmm.
What might we be testing on with
FHA provides mortgage insurance. Owner occupancy is required. 30-year term. I mean, that's just the characteristics of an FHA loan. I mean, that's the, you know, they provide mortgage insurance. What do they not do? They don't make loans. They don't set rates. It's not their job. They don't buy loans. They just provide insurance on the loans. They are a mortgage insurance program.
So that would be kind of like on a test. FHA buys.
Well, what they're going to do is they're going to slide some of that false information into a statement. You know, they're going to say, which of the following is a characteristic of FHA loans? And one of the statements is going to be, lenders are required to utilize the current rate set by FHA in issuing the loan. Was that a true statement or a false statement? That's false, because FHA doesn't set the rates. Who does? The bank does. The bank does. All right, the next type of government-backed loan, which means not conventional, because conventional is not government-backed, right? So the next type of government-backed loan is the VA loan. VA loan stands for Veterans Administration, or Veterans Affairs, okay? This loan is for veterans. In order to qualify for this loan, you have to be a veteran. This is also just mortgage insurance. The VA does not make loans. The VA does not set interest rates. The VA does not buy loans. What does the VA provide? Insurance. Who makes the loans? The bank does. Okay? The bank does. It's just like FHA in that regard. There is one major difference between a VA loan and an FHA loan, other than the qualification guidelines. Obviously that's different, because FHA loans you don't have to be a veteran to qualify for. Here's what you get for your service. You get to go from 96.5% up to what? 100%. VA loans are 100% loan to value, whereas the maximum with an FHA loan is 96.5. So essentially a veteran can purchase a home with no down payment utilizing this loan. And that's the only ones who should consider getting it. Please do yourself a favor, and most importantly do your clients a favor. you're going to have veterans that come to you and they've just gotten out of the service, and the first thing they're going to say is, yeah, we're qualified for a VA loan. Good. Now let's get you qualified for something a lot better. That is the first conversation you should have with them. Because are they going to likely come to you with the assumption that they should get a VA loan? Yes. And the truth is, they shouldn't unless they can't qualify for a conventional loan. I've heard of people who put 20% down and got a VA loan. Whatever lender wrote that loan should be beaten with a brick. Because they just took advantage of somebody. Because why did I say you didn't want an FHA loan? Because of the what? The fees. Guess what? This was the same way. It's a very fee-heavy loan. That mortgage insurance, it's just as expensive from the VA as it is the FHA. So, borrowers should not go for these kind of loans unless they've already tried to be qualified for a conventional loan and they can't get it. Because ultimately, it's always going to be better for them to have a conventional loan. Is everybody following me on that? I'm giving you that advice because you don't ever want to find that out after your clients have closed and figure out you could have saved them a few $1,000s with a different loan type. And it can be thousands of dollars. Okay? Everybody okay with that? Yep.
No question, I want to be big about it. But if you did a VA loan at 80-20, it cost you more for the origination fee. But what if you wanted the assumable? You wanted some other things that this loan may.
Well, I mean, I think you'd have to weigh. That is true. That is true. It is assumable, and that might have some value in the future. But you'd have to really weigh out what you thought that value was going to be versus what you were definitely paying right now to get it. You know, because you're probably going to be paying $2,000 more in fees up front, just for the right to have it be assumable. And I don't know if that's probably worth it. You know,
Is that the only thing that would be worth it?
that'd be the only thing that'd be advantageous that I can think of.
Loans.
Right. That'd be the only thing I could think of that would be advantageous. Would be that.
Yeah, it's takes advantage, but it's getting something.
It is assumability. Not much of a trade-off.
Right.
Yeah.
It's worth the money.
Right. One other thing you need to know on this slide about VA loans is the appraisal process. The appraisal, tell them I said hello. The appraisal process is different. In fact, it's very different for VA loans. And there's a note I want you to put on here that I don't have on here. Okay? With a VA loan, first of all, the appraisal process is called a certificate of reasonable value. A certificate of reasonable value. VA loans are different than any other loan type in that they require the property to appraise for the sales price. If the property doesn't appraise for the sales price, the seller has to release the buyer from the contract or reduce the price. They don't have a choice. Does that make sense for everybody? So we're under contract for $280 and the house appraises for $250. The seller has two choices. Either do what? Let them go and give them all their money back, including due diligence fees, earnest money deposits, the whole 9 yards, or reduce the price to what? $250. That's very different than any other loan. No other loan protects the borrower in that way. Okay? So that is required with a VA loan. So as a seller, if you're accepting an offer and you know the borrower's getting a VA loan, you should weigh that in to consideration. You know, you have to be pretty sure the property's going to appraise. Does that make sense for everybody? Okay, so that certificate of reasonable value is really important in a VA loan. Now when it comes to qualifying for the VA loan, we said you had to be what in order to qualify? A veteran. Veterans have what's called an entitlement to a VA loan. They have an entitlement. They can only use their entitlement once at a time. Not once, but once at a time. Once they have used their entitlement is tied up in that loan until that loan is what? Paid off. Okay? So let's talk about that. That's fine as long as they're selling the property say they want to get a VA loan, they want to sell their house, and they want to buy a new house, and they want to get a new VA loan. They can do that, because as soon as they sell their house and they pay the loan off, they're going to get their entitlement back. Does that make sense for everybody? And they can use their entitlement for the next loan. When would a veteran lose their entitlement, though? When would their entitlement not come back to them when they sell their house?
Assumption.
If it's assumed. If they allow somebody to assume that loan, and they can, it's a fully assumable loan, and that person does not have to be a veteran to assume that loan. They can allow anybody they want to assume that loan. But their entitlement stays tied up with that loan. So they can't go and get another VA loan until that loan gets what? Paid off. Think of it like a token. When you get out of the service, they give you a token. Here's your token for a VA loan. When you get the loan, what do you do with your token? You cash it in. If you pay the loan off, what do? They give you the token back. But if you don't pay off that loan, if you sell your house and let somebody else assume the loan, where's the token stay? Stays tied up with that loan in that house, and you won't get it back until that loan's been paid off. Does that make sense? Okay, so that's an entitlement with VA. And keep in mind, you don't have to be a veteran to assume a VA loan. Anybody can assume them. You still have to go through the qualification process. It's not like you can just have no qualifications. They will qualify you as if you were getting the loan, but they just waive the requirement that you be a veteran if you're assuming an existing loan. Characteristics of VA loans, very similar to FHA loans, no prepayment penalties. They are assumable. And the entitlement gets restored when the VA loan is paid off. That's pretty much, yes sir.
So this one doesn't have to be owner occupied?
That's an interesting question. No, it does not. Generally speaking, the VA loan allows more flexibility. It's more like a conventional loan in that regard. It allows more flexibility. VA loans do allow for some investment opportunity, whereas FHA loans don't.
And that's, so the FHA loan doesn't until you have 20% equity in it?
Yeah, FHA loans will specify a certain number of years. Like if you've had the loan for, usually it'll say owner occupancy for 5 years. But you'd have to look in the note, in the specific note to see. But usually it'll say, you know, you certify it's going to be owner occupied for at least the next 5 years. Now after that, if you wanted to have somebody rent it, that'd be okay. But what you can't do is go out and buy it with an FHA loan and immediately put a tenant in there. Yeah. Okay, everybody good on these? All right. The last type of government-backed loan is the USDA loan, the United States Department of Agriculture loan. This loan is made in rural areas, so it would not be a factor in a place like Raleigh, for example, but some of the outskirts of Wake County do qualify. This loan only exists in rural areas. You actually have to go and look up the address on a map and see if the area qualifies for USDA financing. The idea is to incentivize people to buy property in more rural areas. It's meant to try to generate interest in rural areas. The advantage of this loan is it's 100% loan to value. So if you have somebody who doesn't have a down payment, they're not a veteran, they're kind of shut out of an FHA loan, but they could do a USDA loan, but they wouldn't be able to choose where they buy. They're going to have to live in a rural area in order to do it. Okay? I doubt you'll see a question about USDA loans, quite honestly, but if you do, that'd be all you would need to know. You will see questions about FHA and VA, though. Certainly. Both. Other types of loans that you could possibly see, owner financing or purchase money mortgages. They mean the same thing. Owner financing and purchase money mortgages are the same thing. Now, this is where the owner, the seller, is selling the property, but also financing the sale. So they are lending the money to the buyer, therefore, and selling the property. Now, this is not an installment land contract. Remember we talked about installment land contracts. In installment land contracts, the title doesn't transfer until what happens? Until it's paid in full. With seller financing, the title transfers at the very beginning, just like any other transaction. It's just the seller, rather than getting all their money up front, is going to take a note away. They're going to have a promissory note, and the buyer's got to make payments to them. If the buyer defaults, what does the seller have to do? Foreclose, just like any other lender would. You have to go through the foreclosure process. That is seller financing. It's also called a purchase money mortgage. Does that make sense? You might see the phrase, and the owner takes back a note. In other words, they leave closing, and what they come back with, rather than cash, is a what? A note. They don't come out with the deed. They sign the deed over. They come out with a promissory note, because the borrower's going to do what? Pay them back in payments. You gave up the property, you took back a note. That's owner financing. Okay? And finally, construction loans, or not finally, but pretty close to the end. Construction loans are another specialized type of mortgage that they might ask you about on the test. These are by far the most risky real estate loans that can be made. Here's what's happening with a construction loan. Money is being loaned so that the property can be constructed, so that the improvement can be built. Why do you think this is risky? A lot could go wrong building it. How about, could they not build it at all?
There's nothing there.
Yes, there's nothing there. We're lending money on a piece of what? Vacant land. Would you feel comfortable lending a couple $300,000 on a piece of vacant land that's worth $30,000? Does that sound pretty risky to you? It's exceptionally risky. These are almost impossible to accomplish in the real world because of the risk associated with them. You have to have a very good relationship with a bank to get a construction loan, because it's very risky from the bank's perspective. Now, that is not what you would get when you buy a new construction house. You're not getting a construction loan. Who got the construction loan in that case? The builder got a construction loan. You're not borrowing the money until the house is already completed. So your loan is just a normal mortgage loan. It's the builder who had to either have their own cash to build it or get a construction loan to do so. Very risky, going to be high interest, and really hard to come by. Everybody okay with that? All right. Mortgage priority. You may see this on a test where they talk about the difference between a first mortgage and a second mortgage. We mentioned this before, but what does that mean? If you see something that's the first mortgage, that means it was just recorded what? First, and means it's going to get paid first. Second mortgage means it was recorded second, it's going to get paid second, or junior mortgages. They're riskier. Second mortgages are riskier because they get paid second. The later you are in that line, the more risk you have. All right, some pieces of legislation or laws that we need to talk about, and then that'll wrap up this chapter. The Truth in Lending Act. The Truth in Lending Act, or TILA, not Tila Tequila though. The Truth in Lending Act is a federal law which governs any type of loans being made, not just residential, not just even real estate loans, but any type of consumer loans that are being made. And the Truth in Lending Act is basically an advertising law. It says if you start to advertise financing, then you have to be truthful in your advertising. And for test-taking purposes, here's what you need to know. You need to know what Regulation Z is of the Truth in Lending Act. You will see a test question about Regulation Z of the Truth in Lending Act. Regulation Z of the Truth in Lending Act says that if you're advertising a loan, you can't give part of the picture. You've got to give the full picture. And it defines what the full picture is. The full picture are the things in that first bullet point up there. So if you're advertising a loan, what do you have to tell people about that loan? It's what? What does APR stand for? Annual percentage rate. So the interest rate on the loan. Okay. What else? Finance charges. So like discount points, origination fees, all those kinds of things. You got to disclose those if you're advertising a loan. The number and amount of all payments. So how much is the monthly payment and how many times do I have to make that payment? Is it 15 years? Is it 20 years? Is it 30 years? Does that make sense to everybody? And then finally, the total amount I'm financing. Because here's what happens a lot of times. They'll tell me, well, you can own this car for $299 a month. Well, how? How many times do I have to pay $299 a month? For the next 20 years or for 5 years or what is that? So that's what the Truth in Lending Act is about. It's about giving you that full picture of a loan. Does that make sense for everybody?
Is this like the last 5 seconds?
Yes, this is the fine print, blah, 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 on those commercials. That is exactly what this is. But it comes into picture for us as well, because do we sometimes in real estate advertise loans? Sure we do. Sure we do. Here's what the law says. You're not advertising a loan unless you use a number. Numbers are trigger terms. Not just any numbers. Loan-related numbers. Are you going to put numbers in your listings? Yes, of course you are. Square footage is a number. Number of bedrooms is a number. All of those are numbers. The address is a number. None of those are trigger terms, though. But if I put in the listing, 100% financing available, is that a loan-related number? Yes, that's a trigger term. Here's what it triggers or causes me to do. I have to now disclose those 4 things about that loan. If I'm going to say 100% financing available, I have to tell everybody what the APR of that loan is, what the finance charges are associated with that loan, what the number and amount of the payments is, and how much is financed. You need to know those 4 things for the test, and you need to know how to identify a trigger term. 3,000 square feet, 2-bedroom, 4-bath home on 180 feet of lake frontage on Lake Gaston. Low monthly payments available. Have I used any trigger terms? No. I said low. Where was the number in there? 2,800 square foot, 3-bed, 2-bath house. Payments as low as $895. Is that a trigger term? That is a trigger term. 0 down. Is that a trigger term? No money down.
No.
No, that is not a trigger term, because no is not a number. It literally is that specific. Okay? Any numbers relating to a loan are considered trigger terms. Low percentage rate, low monthly payments, all of that is fine. That's not a trigger term. But payments from $525 a month, that's a trigger term. Does that make sense? And if I use a trigger term, what 4 things do I have to say about that loan now? The APR, finance charges, how much a payment is per month, and how many of those payments I got to make, right? And how much you're borrowing. I got all those things just because I use that one trigger term. So what do you think the message there is? Don't use what? Don't use trigger terms, so you don't have to worry about that mess. Okay? So trigger terms, and these are just some examples. Payments as low as $850 monthly, that would definitely be a trigger term. 5% interest rates available, yes. Own for $1,000 down. Like for the last one, own for $1,000 down. Could I easily restate that and not have it be a trigger term? Could I just say low down payment? Yeah, if I say low down payment, that's not a trigger term anymore.
What if you're like own for $1,000 down?
Ooh, I'm gonna let the federal government decide on that one. That's an interesting one. I like the way you think. Devious, but it's all right. He said own for $1,000 down. The Equal Credit Opportunity Act. Equal Credit Opportunity Act, we talk about this because it's a finance law, so it comes up right here. Basically prevents people from being discriminated against in getting loans. It disallows discrimination in the lending process. Now this has nothing to do with the property selection process and everything to do with lending. We can't be guilty of violations of the Equal Credit Opportunity Act. Who would be guilty of violating the Equal Credit Opportunity Act? Lenders would be. Now, here's going to be the thing, and I want you to put it in your notes. We haven't done fair housing yet. It's coming soon, probably next week. When we talk about fair housing, you're going to learn there's 7 protected classes. Well, there's also 7 here, but they're different. The first 4 are the same, but then you've got some different ones at the end. For example, and that's why they're underlined here. Marital status and age are not protected classes under fair housing. They're not. That means it is perfectly fine to discriminate. Can I put a sign out in front of the house that says, no married couples allowed, and be legally okay?
Yeah.
Yes, because marital status is not protected in fair housing. But what I could not do is, if I was a lender, I could not deny somebody a loan because of their what? Marital status, because it's protected under the Equal Credit Opportunity Act. Look at age. Now this is going to be a tough one. I ain't going to throw it at you on the test. Age is a protected class here. So can you deny somebody a loan because they're too old? No. Even a 30-year loan. You got somebody who's 92 and they want to get a 30-year fixed rate mortgage. You can't deny it because of their age. Age is a protected class under the Equal Credit Opportunity Act. Here's what's interesting though. It's not a protected class under fair housing. I can put a sign out in front of the house that says nobody over the age of 80 can live here. And that's not a violation of the Fair Housing Act, but it would be a violation of the Equal Credit Opportunity Act to not give them a loan for that same reason. Yeah, we're going to talk about those 55 and up communities, but that's one of the reasons they can have them, because it's not a protected class. Okay. Does that make sense for everybody? Okay. So the Equal Credit Opportunity Act basically says loans can't be denied on the basis of race, creed, color, religion, national origin, sex, marital status, age, or dependence on public assistance. That's the newest one that's been added. Basically, there were some lenders at some point in time who were denying people because they were on disability, for example. You know, because when you go apply for a loan, one of the first things they want to see is your income. And so if somebody's applying for a mortgage loan, their income comes from a disability check, or their income comes from Social Security, or their income comes from some other assistance program, whatever that happens to be. The Equal Credit Opportunity Act now says that if it's income, it's income. You have to count it. You can't pick and choose. You cannot discriminate and say, well, we don't count that income. That's what we mean by that being a protected class. Okay, everybody good on that? All right. Oops. And then the Fair Credit Reporting Act, what you should know about that is you are entitled once a year to receive for free your credit report from the 3 major credit bureaus. Of course, in the case of Equifax, they've given it to everybody on the planet already anyway, so apparently everybody's entitled to see your credit report. They've had a bad year the last year. But you are entitled to 1 free credit report a year. What I would suggest to you when you get in this business, go take a class on basic credit scoring. You'd be shocked at some of the things that you think you know about credit that you don't realize. There are some things that are very counterintuitive about credit. Like, for example, if you have a client who has, let's say they pull their credit they go apply for a loan and the lender pulls their credit. And the lender's like, by the way, did you know you owe your you didn't pay your cell phone bill from 12 years ago and it's showing up on your credit as a collection. And it's $120, just FYI, it's showing up there as a collection account on your credit report. What would you think most rational people would do in that case?
They would want to go pay it.
Go pay it. Don't do it. Don't do it. Because you pay it, it makes it like it just happened. It actually will cause it, which is it's the craziest thing I've ever heard of in my life. You know, it's like, you would think you would get credit for paying some collection, but it actually makes it worse. You can take somebody who did qualify for the loan with the collection on there, they pay the collection, and now they don't qualify anymore. So none of that's going to be on the test, but I would highly encourage you to, to sit in on like an afternoon session. Lots of lenders offer them because they get real frustrated with, people doing silly stuff and they were qualified, now they're not qualified anymore. So they offer classes all the time for real estate brokers to just kind of quickly say, these are the do's and don't do's.
Another thing everyone was saying at the meeting the other day, don't pay the collection agency, pay the actual
The creditor.
Credit will originated.
Right.
And tell them to take it off. And if they don't, tell them because it costs you employment like 24 hours.
Yeah, it's more complex than it may seem.
Yeah.
But you are entitled to one free credit report a year from each of the 3 companies. Last thing here, loan fraud. I don't know, what was that? Don't do it. It's a felony. You go to jail for it. The fine is only $1 million. And it's only 30 years in prison, so you'll have to decide if it's worth it for you. You do need to know those. It's a $1 million fine and 30 years in prison for felony loan fraud. And even just something as simple as saying, I'm going to live in this property on an FHA loan application and then putting a tenant in there is felony loan fraud. Technically, that could be prosecuted. So be very careful about loan fraud. The definition of loan fraud is any false statement made to a lender to try to qualify for a loan. Any false statement made to a lender. Whether that's falsifying income, or falsifying assets, or falsifying a job, or just saying, I plan to live in the property when you really don't. That's all considered loan fraud. A lie. Any lie on that application is loan fraud. And that's it for finance. I know y'all, I wish we could do it more, right? Just keep going. Don't you love it? Everybody's favorite part of the class.
When are you teaching this again for,
Never. I've given up after y'all made it so bad I can't stand it anymore.